Welcome back to another video in the index comparison series. It's been a while since the last one, and all of a sudden we're near the end of the year. What that means is that these funds are all nearing a full 12 months of data in the spreadsheet, and the individual performances are speaking more and more for themselves. I appreciate all the comments and suggestions received in the last video, and we'll address them all in this video to help provide a more accurate analysis of these funds. So if you own any of these ETFs and want to keep track of these updates, feel free to help out the channel by subscribing for future videos and giving the video a thumbs up. These videos take a long time to make because of all the animations and extra details I include in each video. So if you can also share the video with those who might be interested, it would greatly help the channel grow. Now let's get into the comparisons. So for this series, we're focused only on enhanced covered call strategies, which means that all these funds use a degree of 25% leverage. But why leverage? Because that extra 25% boost helps mitigate some of the upside that can be capped with the covered call strategy and brings the performance closer to the indexes. For a more in-depth step-by-step overview of how these spreadsheets were put together, you can refer to the previous video for more information. But to go over some of the changes that I've made going forward based on some of the previous comments, I've changed all the underlying indexes we've been using in the past comparisons. The reason being is due to the differences in currency hedging between the ETFs and the indexes being used, which can lead to an edge in performance over time that is more so based on the exchange rate and isn't reflecting as accurately the performances of the strategies themselves. So with that, the new comparisons for the S&P 500, it'll be two pairs between VFV and USCL and VSP and HYLD. For the NASDAQ 100, it'll be QQC and QQCL. Then finally, for the TSX 60, it'll be between the three of XIU, CNCL, and HDIV. Next, it was also brought up the differences in the underlying holdings of some of these ETFs, specifically HYLD and HDIV. Unlike all the global X ETFs, which hold the underlyings which are very similar or identical to the indexes, HYLD and HDIV are more broadly based on the indexes. What this means is that they do not actually own the same holdings as the indexes, but a small selection of stocks that represent each of the sectors within the indexes. So if we look at the holdings within HYLD, we can see it's mostly comprised of their yield maximizer ETFs that are meant to replicate individual sectors within the index. And then there are also some US Treasury and bond ETFs. Now if we dive deeper into each individual ETF, we can see that each one holds a selection of 15 to 25 companies that Hamilton has handpicked to represent each sector. What you'll notice if you take a closer look is that some of these holdings are duplicated across some of the ETFs. If we were to take out all the duplicates, we'll get a list that looks like this. Some of these holdings, specifically in the gold, energy, and real estate ETFs, are not actually in the US or not listed in the S&P 500. So excluding those, we get a total count of 87 companies, which if you do the simple math of dividing by the 500 companies in the S&P 500, you get a percentage of 17.4%. So this is just a note to the difference in coverage when you are comparing the performance to USCL, which actually owns all the 500 companies. Then for HDIV, this is where it gets a bit more controversial in comparing it to an index like the TSX 60. Let's start by looking at the holdings within HDIV, where we see it's similar to HYLD in that there are some overlap in holdings of the yield maximizer funds. It also holds other ETFs as well, but if we were to reorganize the holdings and then calculate the percentage weighting, we see that aside from the US Treasury bill and bond ETFs, about 60.3% of the holdings overlap with HYLD. The problem here is that a majority of these companies in the ETFs are primarily US based and does not accurately reflect the TSX 60. Of this 60.3%, approximately 8.6% of it is Canadian. If we add up the weighting of the other ETFs that are actually holding Canadian stocks, we get a total of about 62.1%. So while yes, this is higher than the percentage weighting of the US based ETFs, the US holdings still provide significant exposure in its performance. Also as a note, if you're wondering why these two added together are higher than 100%, that's because HDIV uses 25% leverage. So the total percentage weighting should total near 125%. Now if we do the same as HYLD and dive deeper into the Canadian ETFs, these are the individual companies within each one. Again, there are some duplicates that are held across the ETFs, so if we take out the duplicates, we end up with a list of 42 companies. If we do the simple math again of dividing that by 60 companies in the TSX 60, we get a percentage of 70%. So the question to be asked is if this is even a fair comparison to be made with an index like the TSX 60. Based on the holdings, it wouldn't be fair just because of the significant US exposure, but at the same time there isn't an index that shares a similar diversification or coverage to compare this to. I think this does it in terms of covering all the comments from the last video. If there are any suggestions or comments, feel free to add it so we can get a more accurate sense of performance among these funds. So for all these comparisons, I'll be looking from the start of the year because it's when a lot of changes to the holdings within HYLD and HDIV were made. These comparisons are going to be very straightforward and as simple as possible, and the first one will be purely based on the stock price. The second comparison isn't much more complicated, and it's simply just adding the dividend distribution that's been paid out to shareholders back into the fund. This is because when an ETF pays out a dividend distribution, it comes from the fund's earnings being transferred to its shareholders. So by adding back the dividend distribution, it will give a sense of what the total return would look like if those earnings were retained. The only exception for the comparisons will be for the NASDAQ 100 comparison, where some of the data was only available starting from the middle of the year. So it'll only be partial, but we can get into that later on in the video. To start, we'll go over the S&P 500 comparisons with USCL and HYLD. With the changes mentioned earlier on, you'll now see 4 different lines on the charts. As mentioned, we'll be comparing VFV to USCL and then VSP to HYLD because of the currency hedging. So when looking at these charts, you want to look at only the 2 specific ones being compared and not the other 2 lines. Starting with the stock price comparison, at the start of the year, there were a few weeks where USCL was ahead of VFV because the distribution wasn't paid out yet. But since the distribution started happening, which are shown by the dots, we start to see the divergence happen over time. While to a casual person who just looks at the stock chart, this might be seen as the ETF is underperforming, but this isn't the full picture because the distributions being paid out are also part of the total return. So nothing here is out of the ordinary, and we just want to make sure that the movements are closely tracking the index with this chart. Now looking at the VSP to HYLD comparison, we see the same thing happen where at the beginning of the year it's aligned closely to the index. Until the first dividend distribution happens, that's when we start to see the divergence happen again. What's different here though is that the divergence is not as large as the previous one between VFV and USCL. An explanation for this could be what was mentioned earlier, where HYLD is comprised of a smaller concentrated selection of only the top stocks within each sector and doesn't hold the entire S&P 500 as a whole. So the bottom part of the S&P 500 that has lagged behind the top performers might not be dragging down the performance as much. That's just my guess, but feel free to let me know what your thoughts might be on this in the comment section below. If we scroll down now to see the chart with the distributions included or the total return, we can see that the performances are much closer than in the stock price comparison chart above. Taking a look at specifically the VFV to USCL comparison, here we can see what I had alluded to earlier, where now taking a look at the bigger picture, we can see that if you include the distributions back into the stock price, USCL is actually on par or slightly beating the index at the time of recording this video. If we were to use a different tool and also include the dividend reinvestments, we can see that this too shows that they are performing on par as well. So at the bare minimum, we can say that USCL has kept up with the index so far this year, while paying an 11 to 12% dividend every month. Now switching to the VSP and HYLD comparison, this again shows us something different than when just looking at the stock price chart. The first observation that stands out is where towards the end of June, HYLD starts to pull away from the index and has actually maintained a clear edge in performance up until today, where it is still ahead. I'm not entirely sure of what could have possibly caused this to happen, other than what I mentioned earlier on about HYLD being more concentrated in its holdings, and that those holdings have outperformed the index starting around that time. Whatever it is, that is quite impressive for a covered call ETF to be beating the index and with that duration of consistency. If we now look at it again with dividend reinvestments, it again shows a strong consistent outperformance during that period of time. So I don't know what else to say, but other than everyone who has held either of these 2 ETFs should be very happy with the performance while receiving consistent dividend distributions each and every month. Moving on now to the NASDAQ comparison with QQCL, I already mentioned the issues with the data in our previous video, so these charts will only be using data starting from the start of May until today. So with the update, we'll now be using QQC to compare with QQCL, and as you can see, similar to the S&P 500 comparisons, the performance of QQCL was closely tracking the index until it starts to pay dividend distributions. The divergence though doesn't seem to be growing very much and is looking to remain fairly consistent over this duration of time. If we scroll down now to look at the total return, we can see that QQCL has for the most part kept up with the index, and since the last distribution in September, started to pull away a bit in performance. If we look at this with dividend reinvestments, it shows the same with QQCL outperforming the index by about 1.99%. Although we don't have the data available for the spreadsheet, what we can do is go back further with this other tool and see what the performance would be from the beginning of this year until now. Looking at it, we can see that QQCL has actually outperformed in total return by 2.58% over the index in this period of time. So again, it looks like the leveraged covered call ETF is coming out ahead in performance over the index. Finally, we have the TSX 60, where we'll compare with CNCL and HDIV. For this, we'll now be using XIU as the index, and from the stock price comparison chart, we can see with CNCL that it follows the same trend as in previous comparisons, where it is on par with the index, and then slowly over time with more distributions, it starts to diverge. But with HDIV, it has performed quite a bit different, with it lagging behind a bit at the beginning of the year, but then has caught up and maintained an on-par performance for the middle months. But since August, it has diverged quite a bit more drastically and hasn't been able to catch up again. Now scrolling down to the total return chart, we see that CNCL has been on par with the index until the June distribution, where it started to underperform slightly on a consistent basis up until now. With dividends reinvested, it doesn't seem to change the returns by much, and that's likely due to the stock price not moving or even showing negative returns at some points during this year. So overall, out of all the comparisons so far, CNCL appears to be the only one that we'd have to say is underperforming slightly. As for HDIV, after the February dividend distribution, it has maintained a consistent edge in performance throughout the entire year so far. But as shown earlier on in the video, this might not be a fair comparison because the US markets have been stronger than the Canadian market this entire year. It should come as no surprise it is ahead of the index. But just to be consistent with the rest of the comparisons, this is what it would look like if the dividends were reinvested as well. So were there any surprises? After not looking at the comparisons since the last video, I was expecting a slight underperformance to start to creep in. Because that last video was back in June, which was before all the big sell-offs we had in July to August, and then again at the start of September. I wasn't sure how these funds would recover with the rest of the market, but surprisingly, they appear to not have missed a beat and continue to perform in line or beating their respective indexes. The drop in the S&P 500 from July to August was 8.49%. So it might not have been a full-on bear market or a catastrophic drop, but it was definitely a good test of what would happen if we were to experience a small market correction. Since the last video, I've also started a position in QQCL because I wanted to include the broader NASDAQ exposure as well to my portfolio. So as of the making of this video, I'm currently up 34.04% on HYLD, 19.05% up on USCL, and 7.02% up on QQCL. These are all core holdings within my portfolio and ones I continue to look at growing and holding into the future. They currently make up 26.65% of my entire portfolio and will probably grow to 35 to 40% eventually. If you appreciate this kind of content and want to support the channel, feel free to subscribe and give the video a thumbs up. I put a lot of time into making these videos, so if possible, I'd appreciate it if you can also share it with others who are also interested in these ETFs. There is also a Discord channel that I've started, so if you'd like to join and be part of a new community, you'll find a link in the description below. Finally, if you want to take a look at the data and charts on these comparisons for yourself, I'll leave a link in the description to the spreadsheet. Thanks for watching, and I'll see you in the next video.